Herald Van Der Linde, Head of Equity Strategy Asia Pacific at HSBC, on the show with us today. Herald, so good having you. As always, I must add, thanks for taking the time out and being with us.
Yeah, good to see you, Neeraj.
Yep, likewise. Herald, can't not start off with, okay, actually there are two things that I could have started off with, the Fed commentary or the upcoming tariffs. So let's start with the Fed. Did it surprise you the way the markets reacted? Because I thought, yes, there was an indication for a September cut, but that was about it.
Yeah, I think so. I'm a little bit in your camp, actually, because I think most economists were talking about a rate cut in September anyway, so it was kind of very well expected. I guess the issue is that we got confirmation of this, and that in itself allows bond yields to come off, interest rate expectations to come down. It rallied the equity market. Remember, the US market had been quite weak in the days prior to that as well. So yeah, that is just now lifting the Asian markets as well. But I'm in your camp. This was reasonably well expected. It's now the pace of these declines starting from here, because as you know, as the Fed starts cutting, very often it doesn't do a one-off. It's a continuous sort of process. So the question now is, yeah, how long is this going to take, and what level are we going to settle at eventually?
Yeah, I mean, do you have a hypothesis around that, Herald? I mean, as to whether it's one or more, and what's the kind of implication therefore on risk assets?
No, I think given that growth is slowing, we will see more. So it's not going to be one rate cut. So I suspect we're going to see more. How that is going to pan out, I'm not 100% sure. What is important for me, I leave that to economists to figure out. What is important for me is that these bond yields, the US bond yields, are starting to come down, because that is really important to Asian equity markets, and maybe a bit of a weaker dollar as well. And all of these things are unfolding. So that's a bit of a positive.
Okay, so that could be one of a positive. Herald, good morning. Hiral on the side. Neeraj just asked you about the risk assets. You're talking about the bond markets. In turn, how are you looking at the impact with regards to precious metals? Because you had gold and silver, which did see a good up move in terms of Friday's session. And from here on, the anticipation is probably silver could outperform gold as well. But taking the way the dollar will pan out on the back of the rate cut expectation, the way bond deals will pan out, do you think there is a trade that emerges for gold and silver as well?
Yeah, I think actually our own analyst, funny enough, our gold and silver analyst is called John Steele, but he doesn't look at steel necessarily, but he's had a preference for silver over gold. The way I look at it is that gold doesn't give you anything. It's a piece of metal, right? It doesn't give you a yield. It doesn't give you dividends. It doesn't give you interest payments. So if interest rates are high, it doesn't make sense to hold on to gold. But if interest rates come lower, the relative attractiveness of gold or silver is improving. So I think this is supportive for gold for that particular reason. In addition to that, we're cutting rates because there is economic uncertainty. Growth seems to be slowing. That's why the Fed is doing so. Now, we're not at a stage yet whereby this is a real big problem, but we're going to presumably look at weaker growth going forward in the US. Now, that again gives a sense of uncertainty that is positive to gold as well. And I think thirdly, gold is, yeah, we're living in a much more sort of uncertain world than we did a couple of years ago. And that supports gold as well. So a lot of things to like about gold, I presume.
Okay. Herald, the other thing is this whole set of pieces done by India. I'm moving tracks now, going to India. And yeah. Start of the year, we saw the monetary policy actions come into play. And now when the tariff sword is hanging above India, I think the announcements on Independence Day by PM Modi around GST cuts and simplifying that structure. Now he's speaking to corporates. They are very constructive, but these are more domestic inward-focused corporates. As a whole, how does this whole tariff limbo, but being countered to an extent by the RBI action and the GST action, mean for Indian equity markets?
Good. I might be making a mistake, but I don't think that tariffs are going to be imposed. So I work in the assumption that that is not a major issue. No, I'm not a political analyst. We'll find out. I think it's the 27th of August for you guys. So we'll see what then happens. But my suspicion is not too much will happen then. You got weaker growth. weaker consumption. Urban consumption has been quite weak over the last couple of months. So the policymakers need to do something. And there are three levers that they have. Now, trade is there, but we just spoke about this. Trade is a different sort of dynamic now. Then you have a lever of lower interest rates and the monetary lever, if you want to put it like that. That they already have done as well. That is quite broad. And if you want to be more specific, yeah, you got to do something on the fiscal side. Now they're talking about these tax cuts, GST cuts and these sort of things. We haven't seen the details yet, so we got to wait for that. But I think it makes a lot of sense, in particular in absence of kind of trade and the tariffs or the uncertainty that lies there. This is something to do. And ultimately, India is a large domestic economy. So it's they need to focus on Korea, Taiwan, Singapore. Those are exporters. So you try to drive growth through the exporting sector. But in India, it's really on the domestic side. So what they seem to do is seems making a lot of sense to me.
Right. Harold, you know, everything you said is perfect. But when you talk about your view with regards to where India goes, you've categorically, you know, come out and said that you have lower rates and fiscal spending that will support India. However, your major concerns have been growth, which could be low, and secondly, valuations that are starting to get lofty, and that's what you mentioned in your June report as well. Does anything change from here on, taking into consideration the GST rate cuts that we're talking about, the way the government is probably planning to spur the economy from a domestic market perspective, because exports, we don't know where the tariffs go from here on. Does anything change from your previous report then?
Yeah, absolutely. First of all, the stock market is not the economy. So what happens in the broader economy and what they're trying to do doesn't always mean that that will automatically be translated in what happens in stock market performance. And there, it's the worries on earnings growth and earnings expectations. Now, we had a couple of worries. Interest rates were too high. They needed to come down. We said this is 12 months ago. But tick that box, has happened, right? We felt that something more needed to be done on the fiscal side. Now they're ticking that box. We felt that valuations were high. That is still probably the case, but not as much anymore. We felt that the earnings expectations of the Indian analysts were too high. So that needed to come down. But to be honest, that's now coming down as well. I think this year's earnings growth will settle at around, say, 7 or 8%. It's probably hovering around 10. It was 18 a year ago. So I think a lot of these things are there. What we now need to see that the positioning and that some of the other markets are moving, and then I think it starts to get better for India. So for the moment, we within a regional context, we have a neutral in India. But yeah, the question is really, when is it time for us to step back in this market? And a lot of worries we had 12 months ago have now been ticked off.
Herald, one more question. There was this whole piece, and maybe you briefly referred to it, but I'll just kind of exemplify it for our viewers, that the kind of underperformance that MSCI India has had versus MSCI EM last 12 months, like 18 months, typically, I mean, there's some math floating around that typically after such a period of underperformance, the markets tend to bounce back unless something domestically is going wrong. We don't think domestically something is going wrong, especially, right, with all the RBI and the government action. Do you think this underperformance itself calls for foreign portfolio investors to look at India afresh, or will this whole tariff piece, if it doesn't move as per how you're thinking, will play spoil sport?
No, I don't think people are too worried about the tariffs. Now, I might be right or wrong on what happens on the 26th, 7th of August, but that's not relevant here. Even if it would be imposed, I don't think people are overly worried about that. The Indian stock market, neither the Indian economy, is very export heavy. It's not like Korea, Taiwan. So it's not a big worry. It just doesn't help either. But for India, for foreign investors to say, really, we're going to go back to India. What I'd like to see is, of course, lower valuations, but also we have a couple of other things going on in the rest of the region that are really important. AI is something that everybody wants to invest in. So they've invested in Taiwan, they switched to Japan and Korea. That's been really driving AI. Now, I think that is a bit overdone already, but the market might still play this particular sort of trend. The second thing that's gone on in the region and sucks up sort of liquidity and takes that away from India is simply China itself. So we've seen a big rally in the Hong Kong market, the shares, Chinese shares listed in Hong Kong. We're now seeing signs that maybe the Asia markets or the onshore market starts to perform as well. But that's big, that sucks in a lot of money. But again, there's a risk to that as well because the underlying economy is not doing so fantastically well. So that comes with risks, in particular in light that this is rallied. So now let's fast forward 2 months. If China starts to roll over and the AI story starts to roll over, it could well be that at that particular point in time, we also get a situation whereby India starts to look more interesting for all the reasons that I mentioned earlier on. So that's the sort of shift I think might be taking place that I'm monitoring. When is AI over? When is China over? When does India look good again? Because that's the sort of switch that I'd like to make, but I don't think we're completely there yet. And who knows what happens in the world? By the time I think it might happen, the world might be different again. But that's how I envisage the next 2 or 3 months to unfold.
So Harold, 2025 and Sensex target of 85,130 still remains. Do you think, would you see an upward revision there or not? And secondly, which are the pockets that you would advise investors to actually look at if you have to look at 85,130 on the Sensex?
Yeah. So will I increase my target or lower it? I don't know, because otherwise I would have done so. But I think the risk of increasing it is much higher than the risk of cutting it. So if I had to make a chance, I think it's going to go up instead of lower. And that's because the growth expectations, these sort of things start to work out to our advantage. Where would I like to play in India? What we've seen in India is that certain pockets have rallied very well, but some of the broader market, the banks and these sort of things, I have a lot of confidence that in the long run, if you want to buy the Indian sort of growth story, that banks and consumers is where you want to be. So that's where I would focus on. I would be careful with those sectors where policy risk, also tariff risk is high. Pharma, for example, would fit into that. So I would be a little bit careful on that particular front. But yeah, it's these companies that can build out their business in India, have a unique product that they can sell. I've always liked that. And it could be retailers, that can be jewelry and these sort of things, and the banks themselves. That's where I would focus on.
Okay, interesting. Herald, completely off context, but I'm moving slightly off India because something caught my eye. And the kind of dominance that an NVIDIA, for example, now has on the MSCI indices or the world indices as well, with the weightage and the kind of size that one company or the Mag 7 have, right? I mean, where does this go to your mind? I know you look at Asia per se closely, but I'm still asking you to hypothesize. Where do you think this goes towards?
This is a problem for Asia as well, actually. And how have people played this in Asia? Most funds are up to here in the largest stock in Taiwan, the chip maker that makes the chips for NVIDIA. They've therefore switched to stocks that correlate with this particular one. They've gone to Korea looking for DRAM makers and these sort of things. So in Asia, we also see this sort of concentrated holdings. It makes me uncomfortable. I mentioned earlier on, for example, we've downgraded Korea quite recently for exactly this reason. Everybody's in the same stocks, and these stocks can do well. But if they surprise on the upside, they will continue to do okay. But if they surprise on the downside, it's a rush for the exit, and everybody wants to go through the same door. So I'd rather be the first one. So I think we're getting to a stage whereby we have to be really careful with some of these markets, Korea, Taiwan. And that works in the favor of India. If that sort of concentration in these markets starts to broaden out, then people take money out of Korea, out of maybe parts of Japan even, and Taiwan. China is at the moment looking okay, interesting, so they could go there. But if anything happens there, I think it could go back to India. And India is then just at the bottom of that adjustment cycle. So that's how I think it might play out.
Herald, nobody can time when FIIs will come in, but I tell you, everybody who's heard this conversation today would be very happy listening to your thoughts, because you kind of know how foreign investors behave, and this, what you're saying, is music to the ears for a lot of Indian investors. So thank you so much for taking the time out and being with us and giving us your thoughts. And viewers, I must tell you, Herald Van Der Linde calls a spade a spade. At times in the past, he's gone out and said that this doesn't look right and therefore India might be a sell or India might be an underweight, what have you. Right now, if he's saying that he believes that there are things around the corner which might turn India around in terms of markets, then you probably got to believe it. So Herald, thank you so much for joining me today. I really appreciate your time.